Part 1, financing your home purchase, everything you need to know about the FHA mortgage loan program. Another blessed day in South Florida. I'm Getchin Sherry, founder of Home Snatch Realty, and I thank you for your continued support. And if this is your first visit to this channel, I welcome you and I thank you for watching. And please do not forget to subscribe, and yes, click on the bell if you want to be notified when I post new videos. But also, please like, comment, and yes, crush the like button and share the video if you find value and you think someone else might find value in it. Now, in the United States, over 90% of all real estate transactions require some form of financing. To finance your real estate transactions, you may choose to use either the FHA mortgage loan program, the VA guaranteed mortgage loan program, the USDA rural housing loan program, and of course you can use conventional mortgage loan products. This video is part 1 of a 4-part series where I discuss everything you need to know about financing your real estate transaction. My focus with these videos is to provide you with detailed information about each financing program. Here, I will discuss everything you need to know about financing your home with the FHA insured mortgage loan program. Now, when you thought about buying your home, you probably thought a bank or a lender will give you a mortgage. Well, that would be a bit inaccurate. After the bank or the lender qualifies you and the house you intend to purchase, the bank and lender determines that you are an acceptable risk, which is a process called underwriting. So after the underwriting process, now in a previous video, I explained the 4 basic steps to a mortgage loan underwriting process, known as the 4 C's of underwriting. Please watch that video for details about those steps and, of course, the qualifying measures that the bank goes to qualifying you. I will post the link on this video. Now, after the bank undergoes the underwriting process, the bank or lender makes the loan to you, the purchaser, the buyer, the home buyer. In other words, the bank will lend you the money. The bank lends you the money, which is basically, we call it, the bank makes a mortgage loan to you. However, you, the home buyer, gives the bank a mortgage on the home, meaning you pledge the home to the bank as collateral to securitize the bank's interests, because the bank wants to protect their money. So what is FHA? The FHA stands for the Federal Housing Administration, FHA, which is a part of the Department of Housing and Urban Development, also referred to as HUD. The FHA is a government agency that insures your mortgage loans for your primary residence, your home. The FHA insures mortgage loans on behalf of the lender. The FHA does not make loans. The FHA insures a variety of loan programs, which include if you're buying manufactured homes, if you're buying a single family home, if you are buying multi-family properties such as a duplex, a triplex, or a quad. So basically 1 to 4 unit you can finance with FHA. Other FHA insured loan products include Section 203K, which is to rehabilitate your purchase. So you can buy a home that needs to be rehab, and that's the mortgage program you would use. It falls under the section of the law that discusses it. It's called 203K, also referred to as 203K. Also, you have Section 234C, which is used when you are buying your condominium complex or condo unit. Also, you have Section 251. If you choose to use an adjustable rate mortgage, also known as ARM, okay, you can use that it falls under that category, Section 251. FHA Insured Mortgage Loan Program does not have any particular income requirement. While there are no income restrictions, most FHA insured tend to finance lower income and first-time home buyers. However, you must meet certain minimum requirement to qualify for an FHA insured loan program, which include the following. The home you are buying must be appraised by an FHA approved appraiser. The home you are buying must be considered your primary residence, meaning it cannot be considered an investment property or a second home. You must hire a qualified inspector to inspect the home, and the inspector must deliver an inspection report that states that the property meets minimum FHA standards. You must occupy your home within 60 days after you close escrow, meaning after you purchase the property. So those are the basic requirements. The qualifying ratios for FHA insured mortgage loans are the housing expense ratio, which is your initial, meaning your front end. It cannot exceed 31% of your total monthly income. We refer to that as the PITI, meaning your mortgage payment will include your principal, the principal payment, the interest payment, taxes, and insurance on the property. Again, that is referred to as PITI. The total obligation ratio, which is the back end ratio, cannot exceed 43% according to the guidelines, the FHA guidelines or Fannie Mae guidelines. Cannot exceed 43% of your total gross monthly income. Now, the required down payment and credit scores for an FHA insured loan program is 3.5% down payment. For your credit score, it must be 580 or higher. But if you are putting down 10% or more on your down payment, your credit score can be within the 500 to 579 range. Now, to qualify for an FHA mortgage loan, you must be able to document your income and have a minimum of 3.5% down payment. You cannot have any recent bankruptcies or any recent foreclosures in the last 2 years. You need to provide at least 2 years work history and a minimum of 500 credit score if you are putting 10% down or more, like I just stated. However, be mindful that your lender may require you to have a much higher credit score than the 580. Most lenders require borrowers to have a credit score of at least 620 for an FHA insured mortgage loan. Also note, the higher your credit score, the better your interest rate would be. At least the better the interest rate your lender will offer you. Therefore, I encourage you to strive to improve your credit score before you apply for a mortgage loan. The FHA mortgage loan programs require you to purchase what is called mortgage insurance premium, also referred to as MIP. And you must maintain MIP for the life of the loan. For as long as you're paying on the loan, you must have that insurance. You will pay at the closing upfront MIP, also referred to as UFMIP, upfront MIP, which is 1.75% of the total loan amount. Let me repeat that, 1.75 of the total loan amount. Typically, generally speaking, that amount is financed into the loan, so you don't have to bring that as a down payment. Okay? The annual mortgage insurance premium is what we call the a MIP, meaning you will continue to pay that is 0.85 of the annual loan balance. So in addition to paying the 1.75 for the initial, the upfront MIP, you will also have to pay annual MIP based on the annual loan balance that you have remaining. That is 0.85%. Now, you can always negotiate with the lender and or the seller. You can ask the seller to pay closing costs. I'm smiling because in this current market, which is a seller's market at the time of this video shooting, sellers will not consider paying closing costs for a buyer. It would be under very rare circumstances currently. However, that is an option. You can negotiate the interest rate with your lender depending on how qualified of a borrower you are, your profile. You or the seller can pay points to reduce your interest rates. The lender cannot charge you prepayment penalties if you pay off the loan early. Your FHA insured mortgage loan is assumable with lender's approval, meaning a buyer can take over your loan balance at your existing interest rate if the buyer is qualified and the lender approves that particular buyer. Now, what documents are you going to need when you apply for a mortgage loan? At a minimum, your lender will ask you to provide your last 2 years W-2 or 1099. If you are self-employed, you have to provide your 1099, and of course, if you are an employee, you will have to provide your W-2s for the last 2 years. Your lender will also require you to provide your last 2 months bank statement to prove that you have sufficient funds for your down payment as well as your closing costs. Your lender will also require you to provide your last 30 days bank stubs, payment stubs. Now, I know we don't have bank stubs anymore, check stubs, but you have to provide proof that you are receiving funds from your employer. That is to prove that you are actually gainfully employed. Your lender will require to provide the actual contract for the sale and purchase of the home you intend to buy. Now, if you are refinancing, your lender will also need you to provide your current deed, your current mortgage statement, and your lender will require you to provide a copy of your home mortgage, homeowner's insurance policy binder, your homeowner's policy binder. Please tune for part 2, where I will discuss everything you need to know about financing your home purchase with a conventional loan product. Now, I've received several questions lately relating to financing, mortgages, particularly FHA. So I wanted to bring, I've answered those. I've had several videos concerning those, but I wanted to bring everything together in one place where you can get all the information in one video. As always, I greatly appreciate you for your continued support, and I thank you for watching. Please don't forget to subscribe, like, comment, share, and yes, crush the like button. And have a blessed and productive day. Stay tuned for part 2. Bye.